Cash, cash, cash. You need to have cash. I don't care if you're going to retirement. I don't care if you're just starting your career. I don't care. You got to have cash, man. And the fact that we're getting paid nicely on cash right now, there's no excuse not to. So I'm reading this book right here, The Price of Time by Edward Chancellor. And I'll put a link in the show notes. You really need to get your own copy and get the hard copy as well because it felt real nice on your book stand there, your bookshelf. And it's just such a litany of various times where economies fell because they had a lack of liquidity. They didn't have enough cash. And so, and I'll read you a couple examples here. And I'm just sitting there thinking, man, it's not just economies as a whole. It's not just companies as a whole, Silicon Valley Bank or the economy of the great financial recession, whatnot, the global financial crisis. That's what it's called, global financial crisis. It's individuals as well. Not having cash can lead to doom. So let me just give an example I'm reading right now. This is from page 75, and I kind of bounce back and forth on this book because it's just so fun to read. And so right now it's called The Overend Gurney. At 3 p.m. on 10 May 1866, a notice appeared on the doors of a building at the corner of Birch Lane and Lombard Street in London. Passers-by were informed that the discount house of Overend Gurney had closed for business. The following day, a reign of terror gripped the financial district. The effect was likened to a shock to an earthquake. Overend Gurney was no ordinary city business. Founded in 1802, its main business lay in discounting commercial bills, turning IOUs into cash for merchants, industrialists, and other city firms. It was the greatest instrument of credit in the UK. In recent years, it strayed from its path of prudence because interest rates were so low, they were reaching for yield. We've heard this time and again. Corporations, countries, individual families. A young partner, D.W. Chapman, advised by unscrupulous types, had tied up the firm's capital into a number of poor investments, which had locked up its assets and securities, promising to repay at a high rate of interest, but incapable of conversion into cash on an emergency. And it had found its resources too limited to meet the calls upon them, except at a ruinous sacrifice to the property, and thus, therefore, suspended payment. A ruinous sacrifice to property. What does that mean? I'm going to let this guy out in a second. So basically, just like what happened in 2008 for companies, for Silicon Valley Bank, for countries, if we go back to John Law's France, if we just hissed over time and time and time, people had debt outstanding and they couldn't raise the cash to meet the payments. And for families in 2008, it was the same thing, dude. You had no cash. Why? Because you were tied up in your equity on your home, or you're tied up in your investments. What happened when you got laid off, though? Well, all of a sudden, you need cash to pay the bills. How do you get that cash? You have no income coming in. How do you get that cash? Well, you start selling stuff. Okay. So what happens to the price of an asset that you're putting on the market for sale? Think about this, just simply. Right now, there's 22 houses in my neighborhood. All right, very small neighborhood. There are none listed for sale. If one listed, it'd be in pretty high demand because it's the only one listed. Every 3 years, a house goes up in the market in this neighborhood. So it's very well thought of, and the turnover is very low. So when one goes up for sale, it gets snapped up pretty good at a pretty good price. What if, though, on the other hand, 5 of us got laid off and all 5 of us had to put our house up for the market for sale? What would happen to the price? The supply goes up. I'm not even talking about the demand here for just a second. The supply goes up, the price goes down. Every single time, this is just basic economics. When supply goes up, the price goes down, my friends. On top of that, too, if 5 of us got laid off and 5 of us are trying to liquidate our houses to raise cash to pay the bills, guess what that means? Well, there's probably 5 guys in those neighborhoods. There's probably 5 guys in these other neighborhoods doing the same thing. So the supply goes up significantly. But what also happens to demand? Demand goes way down. Why? Because a guy trying to sell his house isn't in the demand to buy a house across the street or that neighborhood over there. He's trying to sell his house. Now, he might demand a lower price house, and you might see a little bit of a bump in the price of those lower price houses because the demand has increased significantly, or the price of rentals, something like that. But in terms of your high-end house or whatever, I don't care. High-end is whatever you mean. If the demand, if the supply just jumps out because of something happened, you got laid off, something like that, and you got to raise cash, guess what, dudes? You're going to have a hard time meeting that liquidity event. And so same thing happened to stocks. All of a sudden, out of nowhere, you had this huge flow. I mean, this is what happened in global finance. This is why mark-to-market accounting ruined it, because basically they said, once the price of your bonds that you hold drops below a certain threshold, i.e. it's no longer considered investment grade, you have to liquidate because we have a corporate charter that says we can't hold junk bonds. So once the value of those bonds, or the municipal, well, not municipal, the rating agency rates the bonds lower than what you have to sell it, or once the price drops below a certain threshold, you got to sell it. Well, that's great if I'm the only game in town selling it. But what if there's 10 other banks, 10 other insurance companies all doing the same thing, and it's all gone below, we all have to sell? What happens to the price? Of course, it drops like a brick in water. This is what happens. So what do you do then? Well, then you have to liquidate a freaking nosebleeds. You're like, I'm just going to liquidate this, whatever I can get for it, because I need the cash. So what happens if your liquidity, your cash is tied up in your home, and your cash is tied up in your investments? What do? Well, you got to liquidate when things are dropping through the floor, the price, and you got to find a buyer. So that's what I think about too. I don't have that much cash. I had a bunch of cash, but I had to pay for it taxes. And so now my cash is limited, and I got tons of equity. How do you convert that equity into cash? Well, by borrowing. You can see my wife back there, by the way. There she is. She won't take kindly to be on the video, but you can't really see her. You take that cash by borrowing against you, turning the equity into cash, i.e. through either selling your home or borrowing against it. In 2008, though, man, banks, they tightened up their lending. In fact, if you thought you had a home equity line of credit that had a $100,000 line, they shrunk those line of credits, especially if your loan to value has gone down. Literally, I'm telling you, I witnessed this myself. Banks that normally extended 100% loan to value are saying, no, we can't do that anymore. So once you pay this off, once you pay us back, there's no more line of credit. And you're like, but I need the money. I don't have enough cash. Now, in the old days, you could make an argument, well, I was only getting 1% of money market account. Those days are gone, dude. Now you get 4.5%. There's no excuse not to have cash. Because I'm telling you, if you read this happens time and time and time again. People reach for yields. They take their cash. They say, I'm only getting 1%. That's not good enough. I'm only getting 2%. That's not good enough. I need to get 6%. So I'm going to stretch. I'm going to buy some REITs. I'm going to buy some dividend-paying stocks. I'm going to do this, do that, the other, because at least I'll get a return on my money. Right now, I'm not. And then all of a sudden, you're like, now I need that cash. No big deal. I'll just sell my stuff. Probably appreciating. What if you're not alone? And I'll have to sell my stuff at a discount of 30 to 40%. What if I can't access my equity? What do you do then? And this is the issue. Look, I think about this. I got a bunch of cash right now, just FYI, because I do worry where the economy's going. And as such, I'm cash. I'm not cash heavy anymore because I've been buying some individual stocks, 100 shares there, 100 shares there, round lots on occasion. Not much though. A little bit, but and I read something on Breitbart today or yesterday. It said the economy is actually not nearly as bad as what we initially thought for the first quarter. I'm not so sure I buy that yet. We'll see, but it doesn't matter for me because if I need something, if I don't get cash coming in, I need cash. I still need cash going out, and so it's going to come from one place. It's going to have to come from someplace, either from my equity in my home or from my portfolio. One of those two things. And I don't want to take equity from my home and to convert it into cash because that means I have more debt. I'm trying to get out of debt. You see what I'm saying? So you got to build up cash. What if you don't have enough? Build it up. Build it up. In fact, I'll do another video on this. I'll do my revisit the 2 year before retirement. It's just cash. You got to have cash. Right. Love your thoughts. We'll see you.